Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Michael Hakes, Senior Portfolio Manager at Murray Wealth Group, will be joining us for the full hour. In 30 minutes, we'll be joined by Mark Gode, CEO of Analyst Canada, to discuss the French health insurer's expansion into Canada. And of course, we want to hear from you this morning on First Call. You can reach out with your questions on global equities, and we'll have Michael answer as many of them as he can at the end of the show. The number, 1-855-326-6266. We'll open the phone lines in about a half an hour, and our email address is firstcall@bellmedia.ca. So, some of the stories now we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is calling for de-escalation after Iranian and Israeli strikes hit major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars field. Trump says the U.S. was not involved in the Israeli strike and warned Iran against further attacks on regional energy infrastructure. Eli Lilly says its experimental diabetes drug Rikatrutide delivered record weight loss in late-stage trials, and patients on the highest dose lost an average of 15.3% of their body weight, outperforming existing treatments while also improving blood sugar levels. The results strengthen Lilly's position in the fast-growing obesity drug market, where it's competing with Novo Nordisk. Shares of Micron Technology are falling in the pre-market. They're down more than 7%. The tech company revealed plans to boost capital spending, which drew concern among investors. Still, Micron reported adjusted earnings well above estimates, with revenue of $23.9 billion U.S., also topping forecasts. Micron is benefiting from surging demand for AI chips, particularly those made by NVIDIA. And now our top line story. Oil and natural gas prices are jumping again after Iran launched fresh strikes on key Gulf facilities, including major LNG and refinery sites in Qatar, Saudi Arabia, the UAE, and Kuwait. For more on this, let's bring in our guest for the hour, Michael Hakes, Senior Portfolio Manager at the Murray Wealth Group. Michael, thank you as always for joining us. Another day, things are escalating. What are your thoughts on where we stand right now? Are we closer to war, or do we hope to see cooler heads prevail, or full war, I should say? Not war, we're already there, but a full war after this.
Yeah, Roger, thanks for having me on this morning. Never a dull moment. I think what we've seen over the last day or so has dramatically changed the situation. This is no longer about flow risk through the Strait of Hormuz. It's really about capacity destruction, which is far harder to reverse and very expensive to repair. As you mentioned, we've seen strikes on LNG, oil and refining assets across multiple Gulf territories. And as you mentioned, Ras Laffan was the most recent to be hit. And it could be potentially offline until 2026. So this is definitely a dramatically upping the situation in terms of the impact on global markets.
And it feels like the markets are starting to look at this as real. It felt like for a little bit they kind of were on this optimism that this could end quickly. But now I'm just looking, the Nikkei is off by more than 3%, the Hang Seng by 2%. Kospi, it's always volatile, but off as well. Are we looking at a correction?
Yeah, I think Trump has spent a lot of time bombing his own off-ramps. So that's an issue with this new escalation. In terms of the broader markets, I think inflation expectations are likely to reaccelerate, obviously, especially since we're seeing the collusion of really two, what we hoped was shorter-term things in terms of shorter-term items, inflationary forces. Those are both these new geopolitical risks, which now seem to be going on and on and on, and also these supply-side tariffs that Trump put in. So we've moved from a situation where a month ago we were still looking for two cuts from the Fed, And now they're talking about, 50-50 in terms of either staying neutral or raising rates.
And how much of a factor is inflation? Could we see a global recession, do you think, from this? Is there a possibility of that?
There is a possibility if this escalates again to another level where the war becomes more entrenched. I think we could see like three plausible paths. A de-escalation path, which is probably optimistic now. The strikes pause, shipping resumes, damaged facilities remain offline, however, and they get fixed. And oil sort of settles lower, but not back to pre-war levels. And the gas markets remain tight into the winter of this year. That would probably be the best outcome. The middle case, the base case could be no full regional war, but these intermittent attacks continue. The repairs take months. Insurance, security, and risk premiums remain elevated, and you get oil structurally staying at the 95 to 110 range for the medium term. And then, of course, this global recession we just talked about is the worst case scenario, where you have direct hits on all these upstream fields and the infrastructure, and there's no real resolution in sight. So those would be the three things I would highlight. And
if you were a betting man, you're not going to bet on this one, are you, in any way?
No, I don't. No, it's impossible to bet on these things. I think you need to take an approach where, in this case, things are changing by the day. So we look at our individual stocks we hold in our portfolio. We look at where they're trading now, what the medium to long-term outlook is for these guys, and hopefully all this is definitely not noise, but this new world we're entering potentially, how your stocks are going to fare in those scenarios.
I mean, and that is a big thing to remember with geopolitical shocks like this. For the most part, the stocks recover fairly quickly once it ends.
Very fast. You could see a huge reversion if something were to move in the right direction in terms of the Iranians disescalating, or even the U.S. and the Israelis pulling back.
All right, we have to take a break, Michael, but we're going to be talking more coming up about another potential impact on the economy. AI, it's reshaping jobs in the U.S. Canadians are seeing trade pressures hitting them. Workers are feeling it on both sides of the border. We'll break it all down after this. See how things are shaping up on the markets. We'll start with the U.S. futures, and right now they are soft again. Of course, with the concerns about the escalating violence in the Middle East. Dow up by a quarter, NASDAQ by nearly a half, and the S&P 500 by about 0.3. Now the sell-offs are happening elsewhere. Look at Asia right now. The Nikkei was up by 3.38, the Hang Seng by 2, and the CSI 300 1.60 it was off. Heading to Europe, it's risk off there as well. Look at those numbers. FTSE down by 2.1, looking to drop below 10,000 for the first time in a few months. CAC Caron off by 1.6, and the DAX down by 2.3. And the TSX yesterday, of course, taking a big hit yesterday. The materials index feeling it the most. It was dragging down the TSX. It was off by around 5% yesterday. Overall, the TSX was down 1.87. Some of the winners and losers: MDA Space up 5.8%, ATS 4.1. Going the other way, look at Seabridge Gold down by 12.3, and Boyd by about 13.2. Taking a look at the metals, look at gold. Gold is taking a massive hit right now. I looked earlier and it was only off by about 1%. It's now up by 5.7, well below 5,000. And silver plunging as well, off 11%, below 70 right now. Copper, it's also way off, down by 3%. Now, oil, different story. Western Canadian Select was up 1.8 yesterday. The differential is in the low to mid-teens. And WTI today up again 0.84% at more than 97 a barrel. It is a tale of two labor markets when you look at Canada and the U.S. They're both slowing, but for different reasons. America is seeing productivity gains from AI. Canada is absorbing trade-driven job losses. Let's bring back in Michael Hakes of Murray Wealth Group to break down what this means for workers and the broader economy. Lots of challenges for workers on all kinds of fronts right now. Let's talk first about the AI side on it. What kind of an impact? I mean, we've talked about AI having to be implemented. People want to see results, and now it feels like we are now starting to see it this year.
Yeah, we've been watching both the U.S. and Canadian labor markets through both 25 and 26, and both have been cooling for different reasons. As you mentioned, U.S. is actually experiencing an efficiency-driven adjustment, and despite only modest job growth through last year, productivity is surging through late 25, up 2.8%, even as total labor hours actually have declined. And this is an important signal, as you mentioned, that generative AI may be beginning to deliver measurable output gains. And all that money that we've seen hyperscalers spending on CapEx may be starting to deliver revenues. And this shift has been most evident in the technology and white-collar sectors, where firms have announced well over 150,000 layoffs since late 25, including major reductions that have been directly related to AI adoption. Meta, for example, earlier this week announced 20% labor force cut. Amazon late last year announced cuts. And this is all showing that companies are prioritizing automation and AI first type strategies over incremental hiring.
And I mean, in previous industrial revolutions, there's always been the concern these jobs are gone, they're never coming back. But usually we've seen more jobs created because of that. Do you feel that will happen with AI? The big concern has been it won't. Do you feel, though, that people are starting to see a positive side to what AI might bring?
Yeah, that is the big debate in terms of how fast new jobs will appear versus how fast new jobs may not appear in the short term, because you're leveraging individual employees. So I can do the job now. Maybe I can't do the job, but younger people could do. younger people who would normally, you would need 10 on a team. You may need only 1 or 2 on a team before. So what that's done is entry level and recent grad hiring is really, unemployment wise in terms of the States, is running around 8%. Whereas pre-COVID, you saw those levels around 6. So we could be seeing early days in less entry-level type jobs, because companies are able to leverage what they currently have in-house. You may not necessarily see people getting fired so much, but there'll be less hiring at that lower level.
All right, and then going to the Canadian side, different reasons having an impact on the market there.
Yeah, as you mentioned, we're seeing much more external macroeconomic shocks in Canada affecting the labor market. Trade uncertainty and tariff pressures have driven recent employment losses, pushing employment, as we know, to 6.7% or so. And sectors such as retail and finance have weakened, while healthcare has provided some limited support. And healthcare is also strong in the U.S. in terms of hirings. And back to Canada, although AI adoption has doubled to 12% in 2025, it remains largely augmentative rather than a displacement-driven technology in Canada. So both economies, when we look at the U.S. and Canada, are now operating in what you could call a low hire, low fire kind of environment that protects existing employees, but makes entry-level workers more difficult to find jobs.
Which is the better situation to be in, the trade concerns or the AI concerns?
If you believe the trade concerns are more cyclical, then that's probably better for the labor markets, because you get hired if you get a pickup in terms of industrial sectors, oil and gas, and that sort of thing. If you're in the States where you're much more service sector driven, it could be a bit ominous thinking about if you're a student or a young grad, what your prospects are when you enter the labor force.
And so where are you looking then for opportunities with this?
We're looking for opportunities in companies that can leverage their Gen AI. So we're well positioned in the Googles and the Microsofts and the Metas, the hyperscalers who have all spent billions of dollars, as we know, on CapEx. And the market's concern now clearly is show me the revenues, essentially. So we're entering that phase where the market is skeptical on the CapEx spending. Will they ever see a return on that CapEx spending? So hopefully we're at an inflection point where we can see through the end of this year those revenues coming through.
All right, we have to take a break, Michael, but we'll be back with you, and we'll be talking about why Uber is on Michael's radar. Time now to see what's on the radar from Michael Hakes of the Murray Wealth Group. And Uber, you're ordering it on your radar, are you? That was a terrible joke. I apologize. It's Thursday morning.
I missed it.
Don't worry about it. You missed nothing. Absolutely nothing. Let's talk about Uber. What do you like about it?
I love that it picked me up this morning and brought me downtown really early for starters. But the stock is off its highs of $100 about 6 months ago. And on Tuesday, most recently, it announced an agreement with NVIDIA to launch a network of robo-taxis starting next year in LA and then San Francisco. The bear case on the stock has been that autonomous vehicle players such as Waymo, Tesla, Zoox, which is owned by Amazon, will not need Uber to build their customer base in robo-taxis. We think Uber has an unmatched global network with hundreds of millions of users across geographies. And this will be crucial for those new robo-taxi platforms to gain customers. The NVIDIA deal is just one of several announced. For example, Uber also expanded a commercial partnership with Waymo and Zoox to offer fully driverless robo-taxis, which are offered exclusively through the Uber app in some markets. Waymo, for example, is in Phoenix, Austin, and Atlanta. And Waymo supplies the autonomous driving system and vehicles part of the equation, where Uber handles the fleet operations, dispatch, maintenance, cleaning, and obviously the consumer interface. So why is this important? It's because it validates Uber as a preferred demand aggregator, as they call it, for leading AV developers. And by the same token, Zoox has also just announced a deal with Uber for Vegas in the summer of 26 and then LA in 27. And this is the first time Zoox has partnered with a third-party ride-hailing platform. So this reinforces the role, Uber's role as a neutral marketplace for the autonomous vehicle supply.
All right, we've got a couple more we want to get to here. Primaris REIT, they just announced a new CIO. What puts them on your radar?
Yeah, we think apart from the new CIO, who I've heard is excellent, we think that is trading at a discount to its NAV of over 18%, and this will narrow over time as the company executes its long-term strategic plan. If we back up a bit, Primaris is a Canadian retail REIT focused on owning and managing enclosed shopping centers. Mm-hmm. It yields over 5%. And it's trading at a significant discount, as I mentioned, to the NAV. But there are two primary catalysts. They made two transformative deals in 25. They bought two tier one enclosed malls, which they hope to transform and leverage in terms of their net operating income growth. And also, Primaris owns 9 to 10 Hudson Bay locations, not the downtown Toronto location as we know, but they're mainly in secondary markets. So when Hudson Bay last year entered creditor protection, that allowed Primaris to regain control of almost over 1 million square feet of prime real estate, and management hopes to triple the income from these spaces through 27 by higher yielding projects. So that's why it's exciting.
All right, and we want to get one more in here, and it's just fun to say, EssilorLuxottica.
Yeah, EssilorLuxottica. For those who don't know, this used to be a company called Essilor and Luxottica, and they merged in 2018. Combined, they have between 25 to 30% market share in global eyewear brands, essentially. Ray-Bans, Oakleys. They also own leading lens technologies through Essilor, so those make the lenses for you. And they also operate retail footprint through, we've all heard of it, Lens Crafters and Sunglass Hut. So this scale means there's huge barriers to entry for EssilorLuxottica. And the long-term backdrop is supported by aging populations. My eyes aren't getting any better. Look at those, my glasses. The screen usage, we're using more and more screens, even though I can't imagine being on a screen any more than I already have. And of course, the steady growth in vision correction globally. There's also this other thing that you may have heard about, and that's the Ray-Ban smart glasses. You have an optionality in terms of the Ray-Ban smart glasses, or smart glasses broadly speaking, actually gaining traction after really years of sputtering on the sidewalk.
All right, we gotta wrap that up. I know I have glasses on now. I never thought I'd have to, but I hit 50 and that was it. Game over. Okay, Michael, we got lots ahead. Coming up, we're going to be talking to a major European health tech player which is expanding into Canada with backing from some top Canadian tech leaders. We'll be joined by the company's CEO next. And our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email at firstcall@bellmedia.ca. U.S. President Donald Trump is calling for de-escalation after Iranian and Israeli strikes on major energy sites across the Middle East. An attack on Qatar's Ras Laffan gas hub caused significant damage, while Israel struck Iran's key South Pars field. Trump says the U.S. was not involved in the Israeli strike and warned Iran against further attacks on regional energy infrastructure. Eli Lilly says its experimental diabetes drug retatrutide delivered record weight loss in late-stage trials. Patients on the highest dose lost an average of 15.3% of body weight, outperforming existing treatments while also improving blood sugar levels. The results strengthen Lilly's position in the fast-growing obesity drug market, where it is competing with Novo Nordisk. Meditech has priced its initial public offering below the deal's marketing range, and the company is also raising less money than originally planned. The UK-based Meditech priced its IPO on the Toronto Stock Exchange at $5 per share, raising $40 million. The company initially set out to raise $50 million. However, the shortcoming seemingly reflects soft investor demand for IPOs in Canada. And taking a look at the U.S. futures right now, you can see concern over the Middle East growing. Another off day is shaping up right now. The Dow off by 0.6, the NASDAQ by nearly 0.8, and the S&P 500 by about 0.6, 0.65 as well. Alan, a French virtual health insurer, is expanding into Canada. They just raised $158 million, backed by several Canadian tech CEOs, including those of Shopify and Wealthsimple. We're joined now by Mark Goad, CEO of Alan Canada, and what this round means for their push into the Canadian market. And Mark, thanks very much for joining us. Now, is it Alain, or is it going to be Alan in Quebec, Alan here in the rest of Canada?
We all go with the standard Alan just to make everybody's lives a little bit easier.
Okay, you're going into some rare territory. You're the first new company in this market in 70 years, I think I was told.
Yes. Our youngest competitor in health insurance in Canada is from 1957. So we're really excited to bring a new platform forward, something really focused on prevention, on access, and using AI across every business function to deliver, I would say, a much needed modern experience in Canadian health insurance.
What makes you think you can crack into this market with such established companies there already?
Yeah, it's a great question. I mean, Alan has built an incredible business globally with 33,000 customers, just past a billion in revenue, growing over 50% year over year. So we have a model that we know works, which again is focusing on traditional health insurance. You pay the premium, you get sick, you go to the pharmacist, and then you get reimbursed. Where it's like, how can we flip that on its head? How can we get in front of you and say, what are different daily health challenges we can get you going on that reduce sedentarism, something that Canada is pretty poor on? How can we get you active and moving and start prevention in your daily life? And then how can we connect you with a family doctor, other forms of virtual care providers located in Canada where 6 million Canadians still don't have access to a primary care physician. And by focusing on things that happen before you actually get sick, we can switch from sick care to health care in a pretty meaningful way.
All right. And Michael, I know you want to join the conversation.
Yeah, Mark, this is a super interesting business model you're bringing to Canada. When we look at unmet needs currently in the Canadian marketplace, how do you solve those unmet needs versus all these incumbents and their experience over the decades?
Yeah, I kind of segment the business on the healthcare side and then the insurance side. So on the insurance side, I think for us, it's like very similar to some of the folks that invested in us in Wealthsimple and Shopify. It's like using technology to deliver a 10x better experience. So how can we take reimbursement times down to a few minutes, not a few weeks or days? How do we get back to you when your claim gets stuck within a few minutes, not weeks or days? How can we drive customer satisfaction that looks more like Netflix and Apple, which is where we sit today, and not where kind of the incumbent standard of, oh, this is just how insurance works. So I think we've already kind of achieved and hit the benchmarks that I think when I talk to Canadian business owners, they care about. And then on the second side is, again, really going back to prevention and access. How can we deliver meaningful advancements using things like gamification that I've talked about around prevention, but also using things like artificial intelligence. So we'll be launching one of the first medical AI, medical doctors in Canada by the end of this year. And that'll be a really exciting advancement. We do it in a very safe and smart way, and I'm happy to get into the details. But those are the types of things that are helping us stand out and attract new business in Canada.
Well, let me ask you, but then how are you? Sorry, Michael, go ahead. Ask your question first.
Oh yeah, no, I was getting excited about what you just said. So we own a company. We own a company in our global growth fund called New Holdings, which is a Brazilian-based financial services company, which is all digital, and their offering is to. Maybe you have the same opportunity. The underserved or no service types of people in Canada, small businesses, and your cost to serve as well. When you look at Sun Life and Manulife, maybe their cost to serve each individual client is super high, whereas yours can be super low.
Yeah, so we definitely started in a group that I would consider to be underserved, like small tech companies, 3 people, 4 people, 5 people. But again, we're not starting from scratch. We got to take what works globally, bring it here. And we moved up the market even faster than we thought we would. We just closed a 500-person tech company in Toronto within the first 6 months of launching. And I think that sent reverberations across a few ecosystems within Canada of like, wow, like what we're doing. Again, if you get the core insurance pieces to a point where no one else can compete with you, it's actually something that a lot of businesses in Canada, not just the smaller ones, my heart is in SMB in Canada. Most of us, but 50% of Canadians work at a small business under 100. So that is definitely the biggest chunk of the market, and we're excited about it. But I think you'll see us move up market perhaps a little bit more quickly than even we thought we would, given the opportunity in Canada, the market size, the depth, and the level of competition that we see in the market.
Now, you have no brokers for this. How are you making connections? How are you building your clientele?
Yeah, we go direct with our offer. We want to work directly with our clients. I normally pull up the app when I'm speaking to a founder, a head of HR, and say, here are 3 features that someone called me directly and said, hey, Mark, we want to use geolocation to figure out exactly what the reasonable and customary limits are for this charge. And we built it. So we want to be as close to our customers as possible and show them the speed and pace and velocity. What I like to say is, here's 6 new features we shipped this month. How many new features are in your app that you're using today that you got this year? And we just start to paint that vision of, wow, if we could take this as seriously as a Shopify, a Wealthsimple, what can we build in the next year, 2 or 5?
All right, Michael, we'll give you the last question if you want.
Is regulation a hurdle for you? Do you have all the necessary licenses and everything set up?
Yeah, we work closely with a few different regulatory bodies in Canada. So to answer your question directly, we are actually in the process of getting our final provincial license today. It's a bit earlier than our initial expectations. Again, the market reception has been really strong. We've kind of talked publicly, we're growing over 40% month over month. So we will hopefully be back on soon to announce we are officially Canada-wide in all the provinces and territories, but still coming soon.
And I'm going to sneak in one more question. But going back to having the teledoctors and the AI, how are you going to guarantee safety with that and security?
So the model is live today in Europe, which I think is a really similar regulatory environment. The way it works is just total transparency, right? You enter in a chat, you're looking to speak to a doctor and says, hey, a human doctor, locally registered, it will be in Canada when we launch the service, is available in 7-8 minutes, let's say. You can speak with a medical AI now, and every message will be reviewed. The reality is we ask 1 billion healthcare questions to Google every single day. And Google search is not exactly a safeguarded model around medical literature, whereas ours is, right? And we're building in safeguards to make sure that the responses are in line with what medical professionals on our team and externally through peer-reviewed research, which we've already published, want to see. And that's how you build safe, but frankly, it's really needed medical AI. Like we need AI to help us get through the glut, help us to connect Canadians to better healthcare resources. Like this is a problem today, and we can come at it from a safe solution.
Okay, we have to wrap it up there, but I have lots more questions, and I think Michael does as well, but we have to wrap it up. Mark, thank you very much for joining us.
Thanks so much for having me.
Mark Goad is the CEO of Allen Canada. Coming up, Canopy Growth has completed its takeover of MTL Cannabis. What's next for the company? We sat down with the CEO. That's after the break. And our phone lines are open. Michael Hakes is taking your questions on global equities. Call us at 1-855-326-6266. Email firstcall@bellmedia.ca. Canopy Growth has officially completed its acquisition of MTL Cannabis, a move that creates what the company calls Canada's leading medical cannabis platform. For more, we were joined by the CEO of Canopy Growth, Luc Mongeau.
For us, medical cannabis is extremely important. Why is it important? Because it provides tremendous benefits for medical patients across Canada, veterans. For example, it is a segment of the cannabis industry that is a bit more stable, but it comes with a higher set of regulation. So imagine the product are pharmaceutical grade, so it really drives the organization to have superior level of performance, superior norms, processes, and everything. And for us, becoming number one in Canada, obviously it comes with financial benefits. But it's going to allow us to provide superior service, care, and products for veterans and for patients who really rely on cannabis to improve their lives.
There is a shift, correct me if I'm wrong, in this industry in Canada away from like just recreational use of cannabis towards medicinal use. Is that right? Are you seeing more of that?
Well, both sides are doing extremely well. And what we're seeing is more and more Canadians and actually more and more consumers around the world are turning to cannabis as an alternate source of care or an alternate source away from alcohol. The new generations, we've all seen the reports, consume less alcohol and they turn to cannabis for recreational use.
I know Canada exported more than $350 million in pharmaceutical-grade cannabis last year. So what kind of gives Canada this edge over some of the other global competition?
I mean, we've been at this for many years. The regulations in Canada are relatively high, which really drives the licensed producers in Canada to produce really high-quality products. So for us, we're really excited with the acquisition of MTL because MTL is known as one of the best grower in Canada, very high-quality products, which will position Canopy to really accelerate growth in the international market, especially in Europe.
Even though more countries are kind of ramping up domestic production, you feel confident that Canada still has that upper step and that your company has that kind of higher level?
Absolutely. I was talking to regulators and to distributors in Germany yesterday, and we're saying that, there are many entries coming from other markets around the world at cheaper prices, but they do not meet the level of quality and consistency that's achieved in Canada right now.
Interesting. So if you're looking at other countries, particularly in Europe, I think you said, what countries, is there any specific countries that you're looking at that have more demand?
Yeah, absolutely. The German market is growing extremely fast. The Poland market and the UK market is opening as well. It's all medical business. So for us, that's why, the acquisition of NTL and get access to superior quality flour will really allow us to double down on our growth efforts in these geographies.
What about expansion into the U.S.? What does that look like at the moment?
Well, the U.S. market, as you know, is limited right now. And there's a lot of rumors of when. It's no longer if. So we know it's going to happen. It's when.
In other states, you mean?
No, when they will open up the market and deregulate the market. So for us, what's important at Canopy is we've got significant investments in the U.S. We've got investment in Canopy USA. We've got a limited investment in TerraSense. So we're well positioned to benefit when the U.S. market opens up.
Do you know, I know you maybe don't know exactly, but a rough timeline of when you're hoping maybe that market will open up?
I won't speculate on that. There's a lot of rumors out there. For us, what's really important is that we put the right basis in the U.S. so that when it opens up, when it deregulates, we're well positioned to grow there.
And we know Prime Minister Mark Carney, he set that ambitious goal to double Canada's non-U.S. exports within the next decade, so kind of looking away from the U.S. How do you think your industry and your company fits into that?
Well, to what you said earlier, the Canadian cannabis industry grows extremely good quality flower with very high standard, and that flower is in high demand across the world. So everything that can be done to ease up the regulations that are put on the Canadian LPs to really allow us to be able to be more profitable, to reinvest our business, to increase production. All these will allow us to win globally. Canada really has an opportunity to be the global exporter of cannabis, the largest in the world.
Wow. Let's talk a little bit more about this acquisition now that it's complete. How does that work? How do the two companies merge together with employees and all that? I mean, is that all finalized and done?
Yeah, we're very excited. The transaction closed on Monday. Obviously, we've been working on the integration plan for a while now. The main focus right now is really ensuring that we've got continuity, and that both businesses continue to work and be reliable and provide superior service. So we started integration on Monday morning. We've got a very solid plan, and we plan on delivering significant synergies over the course of the next 18 months.
Lindsay was speaking with Luc Mongeau, CEO of Canopy Growth. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including AutoCanada.
By lies, trapping Canadians.
She's a 19-year-old girl.
W5 uncovers a crime syndicate, hunting for traffickers.
They just asked me to find people for them?
Watch W5, Saturday at 7 on CTV and Crave.
Time to take a look at some of the notable analyst calls and recommendations. AutoCanada having a rough morning. The stock was cut to hold at Canaccord Genuity with a price target of $22. It was also cut to sector perform at National Bank with a price target of $24. These cuts come after AutoCanada released fourth quarter full year 2025 financial results yesterday. Revenue fell short of estimated targets. Analysts worry that profitability remains under pressure and used car and consumer demand is still soft. Micron also receiving a cut this morning to hold from buy at Summit Insights. While Micron reported strong earnings and boosted 2026 capital expenditure, the decision reflects worries that high spending could lead to a future supply glut. And finishing off with some good news, MasterCard has been upgraded to outperform from neutral at BNP Paribas. Upgrade comes amid a strong Q4 2025 earnings report where the company reported a significant earnings beat driven by resilient consumer spending and robust value-added services. All right, when we come back, we'll take your questions on First Call. Time for First Call and first email. The honor goes to Peter. He says, hello, what are your thoughts on the current valuation of Tesla? The PE is extremely high. Is this a cause for concern? Michael, Tesla. Do you love it or do you hate it? You're not. Is there actually a middle ground for it?
I'm actually in the hater camp. just from the viewer's question, they're 100% right, and it's been a multiple stock that's trading at just a very, very modest 192 times earnings, and it's a sort of a cult stock. Elon has been unable to actually, drive any margins through the business as he tries to grow and grow and grow. So that has always been our real hindrance to buying the name, is because it's a car business. And this is the debate, whether or not it is an OEM or it's an actual tech company. We think it's still more of an OEM and should trade more like that. So it's always been a tough one to buy, and it's been fine not to buy this for the last several years. So, and I don't see a real catalyst to get the multiple or any kind of margins through the company, because they have all these new initiatives in terms of robo-taxis. They've changed their production facilities and some of their auto plants to robots now. So he seems to be always on the leading edge of new stuff coming, but never actually becoming a mature company in anything he's doing. So it's been a tough one for us. We don't own it now.
It feels like with Elon Musk, everybody is right about him and everybody is wrong about him.
Yeah, no one's in between.
No. All right.
For sure.
Next email. We've got a few here. Let's get Fred. And he says, what's a good entry point for a buy in Taiwan Semiconductor?
Yeah, that's a great question. So TSMC is a pure play semiconductor foundry, and it manufactures chips for what they call fabless designers, such as Apple, NVIDIA, AMD, and Qualcomm. So as you can imagine, their order book is full. The stock it trades about 20 times earnings. Growing at actually high growth at 30% in terms of revenue line, 31%, and sort of bleeding off into low mid 20s as you go forward. In terms of EPS growth, you're seeing 20% EPS growth. So at a high level, that looks like a very attractive company growing at those levels. And obviously it's because of all this demand from the hyperscalers. Mm-hmm. The stock is almost just off its highs of 2000, I think, Taiwan, whatever their currency is. I apologize.
Taiwan yuan?
Yeah.
I think. Don't quote me.
And yeah, I won't quote you. And then the street target, I think, is 20% higher. So a lot of optimism. There's no sells on the street. Everyone's either buy or strong buys because of this underlying huge tailwind from all the hyperscalers. If you see in this, there's always a concern that the hyperscalers don't see the revenue growth on the other side, but we feel like we're going to see the revenue growth come through, which will be supporting Taiwan Semi. So we will probably be comfortable buying Taiwan Semi here off their highs.
All right, and I wasn't even close on the one. It was it's a Taiwanese dollar. Totally missed that. We're going to go to the next one. Just quickly, Tesla said apparently Tesla just snubbed TSMC and is going with Samsung's new Texas fab for their next gen AI chips. So we got to move on. I want to get a couple more in here. This one's from Jeff and LVMH, Moet Hennessy Louis Vuitton SE. It's bounced off its lows and now appears to be trading sideways. Wondering if this is a good entry point.
Yeah, I would agree. It's a good entry point. It was 640 euros, probably at the end of 26. At the end of 25. and has come off dramatically on the global slowdown, concerns over the luxury market, concerns over China slowing down. This company has, 20 very well-known brands, whether it's Tiffany, Bulgari, Tiffany, and Sephora, to just name a few. It only trades about 20 times earnings. Historically, this has been a very good entry point. I think if you bought it now, you'll be happy in 5 years when the luxury market comes back.
You think it's going to take that long to bounce back?
No, sorry. Hopefully it's before that. We always take a much longer term view. You may see it in 6 months, who knows? But at these entry points, with any equity, you should have a longer term time horizon than 6 months. So if you look out 12, 24 months, we would expect it to be higher.
All right, we got to wrap it up there, Michael, but thank you as always for joining us.
Yeah, you're welcome. Great to be here.
All right, Michael Hakes joining us today. Lindsay's up next with the Open. Trading gets underway in about 30 minutes from now. Have a great day.